Okay, on this section, we're going to be talking about monetary policy. Monetary policy and the monetary base. Again, to back up a second, the Keynesian view, which started with John Maynard Keynes, it was really developed by some people that came after Keynes. There was a guy named Samuelson who wrote a very famous economic textbook, Paul Samuelson, Nobel Prize winner as a matter of fact, and Paul Samuelson put the Keynesian ideas into a textbook format. It was probably the best-selling economics textbook in American history, and it firmly entrenched the Keynesian ideology for generations. It just went on. It's still in print. It's still going. Some colleges still use it. But it's true blue orthodox Keynesianism. It was all focused on fiscal policy, that we solve our macroeconomic problems through government intervention in the economy, and it has two tools, taxing and spending, either increasing or decreasing taxes or increasing or decreasing spending. Then we said we had some problems with that. Some problems with that were that, number one, spending bills have to go through Congress. They're not economists. Then you have all this jawboning about what state is going to get the bulk of this money, and then you have this time consideration of once it goes through, then you have to get general contractors. It becomes very political, very unwieldy, very big, very bulky, and it tends to erode the economy at the freedom level, because whatever government money touches, government regulations control, and regulations tend to control a lot of freedom and innovation in the economy. So for all those reasons, a fellow named Milton Friedman was saying, well, there's a better way of doing it. What the government touches, it really tends to make more difficult. It creates as many problems as it solves, and some of those problems that it solves are not as big a deal as the problems that it creates. So why don't we take this idea of controlling the economy out of the federal government's hands and put it in the hands of people who have the intelligence, the economic background, and the tools, the monetary tools, to fix the problem, and that's called monetary policy. So when we're into Milton Friedman's idea of using the central bank, the Federal Reserve, to control the money supply in order to control the economy, that's what we're talking about when we talk about monetary policy. Whenever we take an economic idea and we turn it into some sort of law, some sort of bureau that has the power of law, now we're talking about policy. We're taking economic ideas, we're turning it into law, we're actually changing the economy. That's called monetary policy. Now, there's a formula for changing the money supply and how it affects economic activity, and it has these 4 letters in it. This is the standard format for it, and I'm going to draw some arrows in here like this to show the idea of causation, that this causes this, which causes this, which causes that. And now the question is, what do those letters stand for? Again, monetary policy is controlling the money supply in order to control the economy. Now, we'll see in a minute, controlling the money supply also includes affecting both high-powered money and low-powered money. And we said a couple sessions ago that the low-powered money creation and destruction had to do with the creation and destruction of fractional reserve loans. Now, when we're moving into monetary policy at the central banking level, we're going to be talking about creating high-powered money and destroying high-powered money, which is something that the central bank does. So, when the central bank, I'll do it with this color here. If the central bank increases the money supply, if it increases the money supply and puts new money into the economy, and we know what banks do when they get new money in the economy, they get to, I got a new deposit here. I'm going to hold out 10, 20%, and I'm going to loan out the rest. When I loan out the rest, that's going to be a new deposit, which I hold out some reserves, and I make another loan, put another deposit, and on we go. So when the central bank increases the money supply, it tends to make money more plentiful, and whenever anything is more plentiful, the price of that thing comes down. When things are very, very scarce, the price tends to go up. Not very much of it around. When there's lots of that kind of stuff around, the price tends to go down. It's the same true as money. When we increase the money supply, there's lots of it around, and it tends to drive the price of borrowing that money down. So that drives the interest, that's what this is right here, drives the interest rate down. So by increasing the money supply, it drives the interest rate down. When the interest rate goes down, people tend to borrow more, don't they? Wow, I could buy this new car and I only have to pay 1% interest or 2% interest. Now, if I had to pay 25% interest, no, I'm not buying that new car. But if I can get a 2 to 5% interest, yeah, I think I might buy that new car. So, same thing with industry. When the prices go down, they will buy more plant and equipment, and this big I stands for business investment. So increasing the money supply drives the interest rate down. When the interest rate gets driven down, then companies tend to invest. They buy more equipment, they increase the size of their factories, and that increases investment. Now, when we have an increased investment, now we're building this new factory and we're buying this new equipment. Well, then we're hiring all these people and business activity is really taking off and the payrolls are going up, and it tends to drive up Y, which stands for National Economic Output. What we tended to call in the past gross domestic product, but it has the nickname of Y for output. And you might have remembered that equation when we saw that one short clip, that rap clip on Hayek versus Keynes, etc. They mentioned this particular formula in there. Now notice, if we don't look at the intermediaries, we say when the Fed increases the money supply, it tends to increase economic activity. That's expansionary monetary policy. We're expanding the money supply and we're also expanding economic activity. Now, the opposite would be true as well, and I'll do that in red. If the Fed decreases the money supply, then that means, wow, there's not as much money out there. There's not as much money to borrow. People who want to borrow that money, they're going to have to bid the price up to get the money. That drives the interest rate up. When the interest rate goes up, businesses don't invest as much because money's pretty scarce, it's pretty expensive, and business investment tends to go down. And when that goes down, it tends to drive the GDP or national output down. Again, if the money supply goes down, then economic output tends to go down according to our monetary policy rule. Okay? Now, this M right here is called the money base, the monetary base. The monetary base, we were calling, or what we now call, high-powered money. Again, what commercial banks create through fractional reserve lending is called low-powered money. What the money that the Federal Reserve creates is called high-powered money. And it's the high-powered money that gives the opportunity for commercial banks to expand low-powered money. But anyway, this monetary base, what is it? Well, it's currency. It's the paper dollars in your pocket. It's currency in circulation. It's also money that's in bank vaults sitting there. We said we had required reserves. Banks have to have some physical money in reserves that you want to come in. You come in and say, I would like to pull $1,000 out of my savings account. Well, they're supposed to have the cash there to fulfill that sort of demand. So it's currency in circulation, and there's currency in circulation in all the shops, all the restaurants, etc. There's vault cash, and the Fed and banks, if they have a lot of vault cash and they don't want that cash just sitting in their vault, they can send it to the Fed and have deposits at the Fed. They can borrow money from the Fed, as we'll see in a second, and that's also deposits at the Fed, although it might not be physical paper, but it's Fed credit. So they can deposit their cash, or they could, at the Fed, and get Fed credit, or they could borrow, what we're going to see in a minute, at the discount window, one of the tools of the Fed when we get down here, and to have credit. And that's all part of the monetary base. It's the most liquid of currency. It's the paper that we exchange in our hands, or the paper that's put in the vault at banks, or on deposit at the Fed. So, that's this monetary base we're talking about. Now, let's go into this next session on the origin of central banking. But this is going to take a little bit longer, and so we're going to take a break here, talking about monetary policy, monetary base, because in order to do this, you need a central bank to do monetary policy. So we're going to back up and say, well, what is the origin of central banks, and how did they come into existence? And that's going to be the beginning of our next tutorial session.